Good morning. Today's Monday, November 7th, the day before Election Day, 2016. We're going to be going over a bunch of things today in and around volatility going into the election, how different markets are being affected. But before we get started, a quick disclaimer. Capital Discussion is not a broker, dealer, or advisor. The presentation that you're about to see is for educational purposes only. We don't know your situation and have no way of knowing the level of risk that's appropriate for you. We're not making any specific trade recommendations. The risk of loss when trading options is substantial, so please be aware of all of the risks before placing any trades. Hypothetical and simulated trades that we're going to be discussed are believed to be accurate. However, actual profits will vary due to such market conditions, liquidity, slippage, and commissions. So, Paul, what did you end up thinking about, the market this morning? It was just a huge run up. One of the things that I had seen, I had done all of these different trades. I was looking at the VXX. I was looking at some trades that just looked to be fantastic for the vol crush that I expected to happen sometime tomorrow, not today. I thought about putting it on Friday, but what I ended up doing, I said, let me wait and we'll put it on during the Monday market Muse for everybody. The best laid plans.
Yes. I have made a couple of observations to my trading partners that not to forget that the day the day of the election, the voting in Brexit, the market was up like 23 points. So the other observation was if the market goes up 1.5% based on the FBI not doing anything, how much is it going to go up if they get the outcome they want?
I'm sorry, based on the FBI?
Yeah, we're up today because the FBI decided that they were not going to continue further with the investigation into Clinton. And that juiced the markets.
That juiced the markets. Oh, the other thing that ended up that was the major thing. The other thing was that the polls, and I don't end up looking at a lot of things when it comes to the whole election because it's just one pundit after another trying to end up getting me to believe his opinion. What I ended up looking at, though, is I look at the Real Clear Politics because it's just basically a summary of the polls. Hillary did start to do a little bit better. It started to end up looking like, Trump was catching up, and that was going to be bad for the markets. Once the polls started turning and the FBI announcement, I think just clinched it. But it's quite a jump. And yes, one of the things that Paul's talking about, and I wanted you to end up seeing this. Okay, this was the day after Brexit. This was the day of the vote. Okay, so all of the pollsters were totally convinced that it was not going to end up being any issue with the Brexit, and that they thought that stay was definitely going to beat leave. And when it didn't, it just made the fall that much harder.
And not only were the pollsters, even the bookies had it at 80% remain.
And but by the way, that's in the UK, the bookies can end up betting on anything, and it's legal, right? So it's if you go down High Street, any major street, you'll end up finding Ladbrokes or so some of these other well-known, businesses, and you can end up betting on elections. And actually, it's a big sport there, as is betting on the American elections. And the odds had been coming down, on Trump. I have not looked in the last 48 hours, but in the beginning, you would have to end up playing 5-1 to bet on Hillary. A month and a half ago, it got down to like 2.5-1. Okay, so and that's what was making the market sell off. But here's the really interesting thing about this. I know that we were down 9 days in a row, but I've never seen 9 days in a row with such, I'm going to call it, little impact. It's not like the the daily averages got to be huge. It was more like this, slow bleed. It was 1/3 of a percent, 1/3 of a percent, 0.4%. It wasn't anything that was, really dramatic. So the fact that they've ended up bouncing back up, and we've got back above By the way, this line right here, the top line that I end up having on the, let me go back and show you. It's probably easiest to see where they are. Okay, and so let me just do this so it's a little bit easier. I had drawn Fibonacci's some time ago, okay, from the low that we ended up having in late 2014, okay, to May of 2015, and that Fibonacci held for a long, long period of time. We did break it slightly, okay, back at the February lows. We obviously, once we broke the highs, we got above it. It really ended up being quite a line where once we broke it, we just went straight up. When we came back down, one of the things, and I think I've mentioned this to you guys before, when I see head and shoulder patterns, I think shoulders matter also. Okay, not just head. So I end up usually I'll end up drawing from the left shoulder. Well, that left shoulder, okay, that we ended up forming, almost 2 years ago at this point, a year and 9 months ago, it ended up being support over here. It ended up being support, and when we ended up breaking it, okay, we kind of ended up breaking it, and then we ended up dropping, I won't call it substantially, but enough. And now we've bounced back up, and we're going right to it. This is why I think it's rather, significant of where we are and what's going on with it. Paul, any comments about the overall chart where we are and the fact that we do have a slight gap here, but that's really minor.
Well, it's excuse me, it's minor on the SPX, but the regular session on the ES, I believe, is huge.
Oh yeah, let me go and do that over here because you can end up seeing a lot. Let me go and get another chart because I'm going to leave that one up and. I have this up. It's just I have to detach it, and Thinkorswim is, with everything open, is being very, very slow. This is what Paul's talking about. This is a 5-minute chart on the ESs, and you can end up seeing what ended up happening. The sessions are in dark black, okay? The grayed out sessions are the overnight. You can see that once we ended up opening up last night that there was a big gap. There was a very big gap. And so it's it's also an event that can end up running us apart. Paul, the other thing, anything else on the indexes? I only really look at the S&P because it's what I trade. Anybody want to look at anything else? And by the way, John Bailey, John, I forgot. English or Australian? We had the conversation once. So John would know better than I do because he's had more history of it. But yes, the bookies are the most accurate. It's funny because the thing is that even financial markets, okay, English, okay. You need to know what John just wrote to me when I asked him if he was English or Australian. He said, English, how dare you? So anyway, yes, the bookies, okay, tend to end up being more accurate, okay, at the elections. In terms of the forecast, I didn't realize that until I lived over in Europe for a number of years. I was like, wow, these guys are better than Wall Street when it comes to their predictions. Anyway, what I also wanted to end up showing you, here was an interesting chart, and some of you guys have looked at this, okay, before. I'm going to end up showing you two things. The first one is I'm going to take a look at the 1 month VIX minus the 3 month VIX. Okay. Now, what this is going to end up showing us is whether we're in backwardation or contango, but it's an easy thing for you to end up doing without having to go someplace else. In Thinkorswim, and let me just make this a little bit bigger so it's easier to see, I can end up seeing, I can put formulas in here. I can use plus signs, minus signs, and multiplication signs. Can't use division signs because it's a slash, and slashes are used for other things. I believe me, I've had many conversations with Thinkorswim. Why won't you give me a division sign or a parentheses? Anyway, so we can end up going through here. If we take a look at where the VIX is minus the 3 month VIX, when the VIX is higher than the 3 month VIX, we go into backwardation. And this ends up saying that the market has some fear. right? Simple, easy way to be able to end up keeping your chart because it's calculated on a regular basis. If we want to, we don't have to end up looking at intraday. We can end up looking at, I'm sorry, at daily. We can look at it at intraday, and you can end up seeing what ended up happening here, and it'll just take a minute. You can see that we really ended up having a big drop. And that's how we had been building, building, building going into the election, okay, that fear was getting greater, what might end up happening. And then once we ended up starting to really end up moving forward on it, you can see the big drop that we had. The other one, Paul, any comments? I know because I think you guys look at this, you and your trading group. Was it you or somebody else?
Somebody else.
Sorry about that.
That's
okay,
all right.
the other one that
I own some VIX puts. So.
Okay.
I'm a very simple guy. I just, kind of look at the simple charts.
Okay. So I tried to end up doing the same thing. Now, remember what ended up happening is that I've told you that VVX, for those that you don't remember, and let me just put up VVX here for a second without anything else. VVX is the index on the VIX. It's the volatility index on the VIX. So if you think about it, it's a second derivative, right? The VIX options are traded, and the VIX options are basically the volatility on the S&P. Well, the VVX is kind of like the VIX formula on the VIX options. And so, and it would help if I could spell VVIX. There we go. It'll come up in a second. And what you'll end up seeing here is that it's the one that institutional investors will end up using many, many times. I've worked with some high-frequency trading firms, and this is the index and the options that they have the largest commissions on, which you'd kind of expect because it's a smaller index. If they're going to play it, they're going to have to play it in huge quantity. But you can end up seeing here that we were building up, and if I come back and I just want to take a look at a longer duration, so we can see what happened for at least the last couple of years, because I definitely want to take a look at what happened, if you remember, not this summer, but last summer. Sorry, Paul. I know every time I do that, you flinch. And there we go. Okay, so we can end up seeing here, why was last summer, June, July timeframe, when we started to end up having the big issues, and then we got into August. You can see the spike that we ended up having. This was why so many good traders ended up having problems, getting through this, because the implied volatility, really changed the skew. What I have found is that when the VVIX spikes dramatically, the lower level puts really take a hit, meaning the puts far below the money. And when that ends up happening, it kind of changes a lot of our structures around. You can see here what ended up happening in January, when we ended up having the sell-off in January. It wasn't that big of a deal. So even though we had the sell-off in January, we had a lower low in February, right? Well, you guys remember, you saw that in the SPX, you saw that in the XPX chart that I had shown, right? That's why I wanted to leave it over here. If we come and take a look at the low here in February, was actually lower than we were in January. However, this was kind of a telltale sign. The VVIX, when you take a look at the spike that we had in January, the February one was lower. You can see that right here. You can also see what happened was going into Brexit, right? This was something that Paul had mentioned, multiple times. And Paul, this is just like confirmation of some of the things that you've talked about before, about how difficult it was trading going into Brexit. If you take a look at what happened going into Brexit, because remember, Brexit, the vote was on the 23rd. we didn't end up having the results until the 24th. So on the 23rd, things were still looking, everybody was like kind of fat, dumb, and happy. We were running up, but it was kind of interesting that we ran up a week before. And by the way, going back to John and the bookie comments, I remember because I was actually in New York and I was at a high frequency trading firm doing some work for them, and we specifically talked about how the line, okay, if you wanted to bet on it in London at the bookies, it was going, it had been changing a lot. But then what happened was that in the last week or so, there was this fear about a week before that they were going to vote leave, and then they were like, "Oh no, that's just nonsense. That was just the polls. It's really going to." And you can end up seeing here that everything looked to be good, but then there was some fear the day before. But look at this. This was the day of the vote. This was the actual date of the vote. Look at how we sold off on it. It was kind of like, oh, the exit polls, okay, say that it was probably going to end up being stay, so we're okay. And it looked like it was going to go through a crush. And when it didn't, we bounced. But here's what was really interesting. Of everything else, how much worse did the fear get from the uncertainty? It got a little bit worse, but it didn't get dramatically worse. So even though when we sold off on the first day, this is the 24th, this was the Friday after Brexit, this was the Monday after Brexit that we sold off even further. But look at what ended up happening. Look at the VVIX ended up going, and it started to end up selling off. And if you take a look, and let me come into here and just highlight this area so you can see it. Here's the day before the vote. I'm sorry, the day of the vote, right? We thought we were going to end up going up. This was the day of the vote. We dropped pretty dramatically. And here was the Monday after, right? The Monday after that we ended up hitting. Not only did we touch this long-term trend line, but look at what happened on the second day of the VVIX on the 27th. The second day was Monday, right? Because the vote was Thursday. Massive, everything kind of hit on Friday in the news, and then throughout the weekend we sold off more on Monday. But even on Monday, we ended up by the afternoon, the VVIX started. So I kind of take a look at this. If there's an index I'm going to end up looking at for a chart, this is an important one. Now, what I've done is that I try to end up comparing and you can end up doing this, right, on a lot of different charts. Paul, any comments on this? Because this is what I'm going to end up showing. Okay, I'm going to end up showing this versus the VIX, and then a formula. But I wanted to kind of turn it over to you too.
Well, I just wanted to add that my opinion about the Monday drop in the market and the drop in the volatility in the VIX, and my theory is that even though the market went further down on Monday, everybody already bought their protection.
That's exactly right.
There was no more put buying on Monday.
That's exactly right. Okay, I mean, guys, I don't know if you realize how, and I kind of just skipped over that point, but I don't know if you realized how insightful that point is. Think about it for a second. If the institutions have already put their disaster, protection in place, so that if England gets towed out to the ocean and sunk because of Brexit, oh my God, will the world end? Well, if everybody has protection in place because the VIX, everything was already bought beforehand, there's no more people who need to buy protection, even if it drops. And if they don't need to buy protection and they don't need to sell anymore because they have protection in place, what's going to end up happening is that once that first flood of sell orders comes through and we get to some type of equilibrium, there's the guys who have protection in place are going to end up looking to put money back to work because they can end up buying stuff a lot cheaper and they already have their protection in place. The fact that we've seen, the buildup of buying of protection going into the event, means that even if the event is not as bad, or even if it sometimes is as bad as they feared, the markets may sail off a little bit, but they tend to end up bouncing. What I was really, what I'm really pissed off about with the FBI about this whole thing is that they freaking, ruined our chance to make money today. Okay, because if the fear kept building up, okay, and there was enough, okay, protection bought, um, then once, okay, the fears were realized, um, nothing really, would there be a sell-off? Yes, there'd be a sell-off. Would it last a day or two? Probably. Okay. One of the things that I had read in terms of read, and that's a problem. Okay, you don't know because you're just reading other people's analysis, and some of it may be there, and some of it may not be correct, and so it's kind of tough to end up seeing some of these things. Anyway, so what I took a look at was if we ended up selling off. Okay, what did it end up meaning to any potential further sell-off? And the fact is that with the implied volatility where we would end up being, I would end up looking at this. Now, there was also the skew issue that we talked about, and I just want to look and see. I thought I had one more. I can't find it here. Just give me one second. Okay. Oh, here was another one. Okay. This one I was gonna I was debating on whether to show uh, this Mark Twain quote or not. And let me just get this because this was another great one. Because you worry about what you read in the newspaper, right? Everybody ends up having an opinion, whether it's back in Mark Twain's day, it was a newspaper. You take a look at what we end up reading from all the different pundits, what we watch on CNBC, and there was this one. Right. I would take a look at this if you don't end up reading, okay, or don't end up watching CNBC or whatever your favorite financial news or regular news station is, you're uninformed versus if you end up watching them, there's a very good chance that you're misinformed. So when I take a look at it, I'd rather go and see, well, where's the show me the money. I want to see where the actual money ends up being. What I try to end up doing here in this graph that I'm about to pull up was that I tried to end up comparing where the VIX was versus the VVIX. Now the problem is that the VVIX is up in near 100. Okay, a lot of times it's at 107 and change. It had come down pretty significantly today. It dropped about 13 points. So what I tried to end up doing is I tried to end up saying, okay, I'll take the VVIX, and this I kind of end up looking at it the other way. When we're above the zero line here, I thought, okay, things are positive. We're moving forward. There isn't a lot of fear. When we drop below here, there does become a lot of fear. And what I did was that I just tried to normalize them. So I took VVIX. I need to have some factor that I multiplied it to get so that it would be somewhere close to the VIX. So I multiplied it by 0.17, mostly because it gave me a long-term line that we were relatively on both sides of the market, meaning if you take a look at this, the amount of fear when we're below the zero or above the zero. I like 17 also because it was a prime number and it was also the favorite number of my favorite New York Met, Keith Hernandez. But those are asides. Anyway, so you can end up seeing here that we did start to end up having some sell-off, meaning that people were using VIX options more than they were using S&P options to protect the downside. Okay. Now, we ended up getting there a lot in the 27th. I'm sorry, on the 24th. And now remember, this happened after, right? This ended up happening after Brexit. And so what ended up happening is that there was protection in place, but the amount of buying of it while it ended up dropping, we saw from the actual VVIX number that we ended up having some sell-off. So it's all just me just trying to take a look at and not listening to what anybody has to say. I'm looking how the market is voting with their dollars. Okay, because to me that's what I'd rather end up doing. I'd rather look and see where the market is, voting with its dollars. Uh, with that, Paul, any other areas, any other charts you want me to bring up, or you want to end up talking? I know that sometimes some folks look at different indexes. I'd be more than happy to type in if you want me to look at any other symbols or any other indexes. And Paul, anything else you want me to show right now?
No, I think you're covering it pretty well.
Okay.
I looked, that we're going into this election and the market started acting like Brexit. I went back and looked at Brexit and looked at the price movements because all you can do is, make a wag, a guess. And, so I saw there was a 100-point move in a couple of days or thereabouts from
right, you can see that from here, right? Right. You can see that we were from, 21, let's call it 2118, down to a low of 1992.
Yeah.
So it was 125 points in 2 days.
So I looked at that number. I looked at the trades. I looked at that number, and I kind of guessed 50-point up move in a couple of days if the outcome was something the market liked. And I looked at all my trades that's how I judged, whether or not my trades would survive. And the 50-point up move based on today is probably low. It might be more than like 75 points if we base it on today. So that led me, to take all my trades off.
Yeah. One of the things that I ended up taking a look at also is I don't know. For those of you that have on any type of a butterfly type trade, broken wing type butterfly, road trip, M3, Kevlar, anything, how have you guys done today? Better or worse than you expected? Yeah, I can end up telling you, for my stuff, we jumped pretty substantially. Now, what's ended up happening is that some vols have come out, but not a lot. In addition to that, what hasn't happened, and if I want to bring this down here, so when I take a look, okay, this is, let me make this larger. Okay, what you're looking at here is the implied volatility skew curves going out for 6 months. If I get rid of some of the old stuff, I ended up reading some things where people said, well, it's the election and there's also volatility in for the Fed meeting. I'm like, really? Really? Are you kidding me? I want you, and here's what it is. When somebody says something, I always listen. I hear where they're coming from, and then I go and check. Okay, because I think that you got to end up checking your own facts. Remember we talked about the concave versus convex, and I didn't use those words. That's what options guys end up calling it. But if you take a look at here, it's the bump, right? It's the bump upward versus the bump downward. By the way, that's concave and convex. Now, normally they'll end up talking about the concavity or the convexity of the options themselves, meaning, okay, where they're being priced. What we're looking at is the concavity or the convexity of the IV of the option. So we're really looking at the second derivative of convexity here. And what we've taken a look at here is, and we've pointed this out, okay, the bump that we've had, okay, over here. And you can see that with tomorrow's options and with, Fridays, that they're high. But if you get that, as the further you go out, there's still this bump. Pretty significant bump. But as you go further out, like, for example, I happen to have Dees and Jan open. I'm going to show you guys November, and I know some of you guys trade weeklies, but I'm going to end up just showing the monthlies first. Let me get rid of all of this other miscellaneous junk so that we can end up seeing. Paul, also, or somebody else, I forgot, when is the next Fed meeting? I think it's the 13th. Is that right? Would somebody just, because we'll look at that next.
I'd have to check.
Yeah, somebody, if you just put it in the chat. Okay, so here's what I wanted to end up going through. November, you can still see that we're rather high. You can see that there's this huge difference when you have a huge difference in volatility. One of two things ends up happening. Either they're the options beforehand or they're significantly far enough behind, okay, that they think that time will end up taking things and normalizing them. And so you can see here that there's just a ton of implied volatility higher. You can see how big the bump is here, or okay, the convexity here of the options slightly below the money. Well, it's also happening somewhat in December and somewhat in January. And because most of us who end up trading butterflies, okay, most of our structures, okay, and it's true whether you trade at the old Jeep structure, if you narrowed it, okay, your Jeep, if you're going to end up doing anything where you have edge, you're going to end up being short puts somewhere below the money and then hedging it off. And since everybody wants to buy those right now, there's been a lot of money that has been lost in our trades, which really doesn't end up having any significance in the sense that it's not going to end up being there afterwards. However, it doesn't mean that you can't get killed, okay, with price movement, right? You may get your Vega dollars back, okay. I've heard some people, right, Paul, and you mentioned this to me because you were speaking to some folks, the same thing, right, that yes, volatility may come out after the election, but that doesn't mean that you won't get killed on price.
Right. Your Delta dollars are going to run right over your Vega.
Right. One of the things that Paul and I used to end up doing, and it was a concept that I ended up looking at only because I needed something simple or being able to try to end up breaking things down into components. That was the old engineer in me many years ago. And then when Paul and I were trading together for a number of years, it was something that we found very useful where we would look and seeing if our P&L changed, how much would it change based on the price movement. Now, the price movement would be not just your deltas, okay? We always talk about it in delta dollars, but the deltas end up changing, right? So it's really your gammas also. And the other thing that would end up happening is that it would never end up being just our deltas, right? Our deltas of where we are, if we ended up moving, usually would be relatively flat. It would be that if we were negative gamma, things would get worse and worse and worse. But people end up saying, well, I'm in good position now, but I'm just losing Vega dollars, meaning the higher implied volatilities at certain parts of the curve are where you're losing money. Well, yes, that's true, okay, in your Novembers, okay, and to a lesser degree in your Decembers or your Januaries, but it's not it's not like once the volatility comes out, yes, you will make back your Vega dollars, but you may make back 10 Vega dollars, but lose 100 Delta dollars, okay, because the markets move so much. So you do need to be a little bit careful of that. The other thing that I wanted to end up seeing, by the way, thanks a lot, guys, 13th and 14th. Here's why I wanted to end up showing you why the 13th and the 14th really doesn't make a difference. Take a look at the huge difference between the volatility between the options that expire before the next Fed meeting and after the Fed meeting, right? It looks so much different, okay? Nobody cares, right? Nobody cares right now. The entire focus is on the U.S. elections, and any pundit who ends up saying different is looking at stuff. It's not where the market's making their bets, because in the end, I kind of take a look at this. I forgot who it was. I think it was Benjamin Graham who ended up saying that in the short term, the stock market is a voting machine, and that's what it is. It's basically where people vote with their dollars. And in the end, where these implied volatilities, if you think about this, it's the collective wisdom of the entire market. Because if, I don't know, some big hedge fund like Renaissance Technology thought that, implied volatility was, too high here, they would be just selling it and pounding it into submission. If, Citadel thought that the implied volatility was too low over here, they would just be buying this into submission till it ended up going back up, right? Because they would end up putting as much money into it as they could. So in the end, this is the collective wisdom of where the market believes that implied volatility should end up being. Okay, and obviously, When we take a look at where we are, out a week, okay, compared to where things are, further on. It's kind of interesting because here, I don't trade these, okay, but if I was a calendar trader, I'd be having a field day here, right? Because you could be now. Here's the whole thing. I don't. I haven't mastered how to hedge calendars if they run on me. Okay, but if you take a look at this, selling higher volatility, okay, and buying something out a month, okay. Now the problem is that when you calendar is no different than other trades, okay. If you end up getting it wrong, okay, it's very difficult to hedge in the last week. The other thing that people do not end up accounting on is yes, the front month is going to collapse, but so's the second month. Okay, people don't end up sometimes realizing that. If I bring this over here, let me just get rid of the disclaimer. What I wanted to end up doing is I wanted to end up getting. Let me bring this over here.
Plus, my personal opinion on the calendars when they're like this, you're kind of making a bet that the balls will come out and the market's not going to move.
Right.
And
that's exactly what you do, Paul.
The only thing that I will guarantee you is that after the election, we're not going to be here.
Exactly.
I don't know where we'll be, but I'm kind of pretty confident that we won't be at this price level on the SPX.
Right. Well, we're going to end up either being, substantially higher or substantially lower.
Right.
One of the things, and here I just wanted to end up showing, if you take a look at something like this, if I take a look at what the implied volatility is, and I guess in the right direction, okay, and I'm not out that far. Maybe I'll choose a few more strikes. But if I take a look at saying, well, I don't need 5,000 strikes. Let's not get ridiculous here. Let's use 50. Let's look up. Let's look higher. So what ends up happening is that the challenge is that if you take a look at November, because of the way that the skews work, right over here, because of the way the skews are, meaning that the implied volatility is much lower over here, it's difficult to get a lot of money by selling these, and there isn't that big of a difference. So if I'm looking at this, I almost by default, if I want edge, I almost have to go on the downside. Right? And so if I go on the downside, and I took the wrong chart. I wanted to leave that here. So if I look on the downside, it's something like, I don't know, let's look at 2050. Why 2050? We were almost there, and 2051 was my address as a kid growing up. Okay, so I got implied volatility here of 26. Now, here's the important thing, okay? Yes, I do, but remember, Vegas melt with time. So I got an implied volatility of 26, and I got a Vega of 108. If I go to the 150s out a month, and I look in December at the 2050s, I have a bigger Vega here. It's 234. Yes, my IV is a little bit lower, right? It's only at 19. I don't know if I can get them both on here at the same time. I'd like to be able to see seeing them. But it's not going to happen, though. Okay, so look at how much bigger my Vegas are in December. So what ends up happening is that if I go down one vol point, I'm going to lose $1.08 in the front month versus, what is it, 234 in the second month. So I have to go down more than 2 vol points in the front month compared to the second month to make money. That's a tough order because once the vols come out in December, what's to end up having the continued fear of market movements? This is an issue in and around in and around an event risk. And so to me, it's very, very difficult to end up playing. It tells me also, by the way, that no matter what ends up happening, um, people don't think that they need longer term insurance. If you thought that if you were in the camp that said, let's say if you were Muhammad El Arian at the end of last week came out and said, if Trump wins, the market's going down 5 to 10%. It had sold off, okay, quite a bit, but he had said that on Thursday morning. I think it was Thursday morning when I read it. Um, it was a short-term move, though, because it's not like the implied vol. If I was worried that it was going to end up going down that far and continue to go down, I wouldn't be buying just November's. I would be buying December's. I would be buying January's, and so this is going to end up being, I think, nothing but a small blip. I think where we've had the biggest effect on things is the way the convexity of the implied volatility changed, and that I ended up showing you from over here. All right, that's what I think is the biggest thing that's changed. Paul, anything else? If you guys want, I'll show you the trades that I had all lined up for you before James Comey, messed up our chance to make money this morning.
No, it's just I had to turn TOS on this morning to look at some charts. I don't even have it running on all the machines. So,
yeah.
I'm fat, dumb, and happy right at the moment.
So what happened with the higher implied volatility, we even had a bigger bump in here. If you take a look at the stuff that ended, let's say on Friday, you can see how we had the implied volatilities were higher on this side, and we had this nice huge bump. Okay, and the VIX or the VXX looked really, really good, and these were trades that I had put on. I didn't put them. I didn't put them on. I got them ready for you over the weekend. Okay, and what what I ended up taking a look at was that I was trying to because this is the logic behind it, and this was the trade that I ended up looking at up here. These were newer ones this morning. But what I was trying to do was remember where we were. Okay, this morning or on Friday when we ended up closing, and I'll show you in a second. Okay, but the VXX was 38 and change. Okay, so I thought 3-point vertical going down and then sell 3-point vertical. Okay, where we were. I had to redo this. Okay, and I had to end up putting it somewhat lower. But the problem is that the pricing wasn't nearly as attractive. Where we were. And so if I end up taking a look at and let's just choose, when I looked at this, by the way, okay, and I did lock down the price, okay, where we were on Friday. This was at $1.01, okay, this vertical. And I'm sorry, this condor. And let me come over to here, and let me just make this a little bit bigger. Let me get so that you can see this. Sorry, I think our swim's being. Let's try that one more time. Let me check. And uncheck everything. I don't know if I have anything else checked. Okay. I can't believe how slow this is, right? I mean, you can see I'm here. Okay. Come on, you can redraw it. Okay, so back when we were above here at 38, okay, this type of structure, I really liked because I thought, well, if we come down here, implied volatility is going to come out of the VIX options. We'd end up getting sucked up in here. I kind of take a look at it. If we ran up, the chances were that if I didn't lose the whole $1,000 on it, I was going to end up losing, $800 or $900 on it. I would end up taking my loss as quickly as I could on that side if we had run up, if I got this trade on today. and there wasn't the FBI stuff, we would still end up being floating around here someplace. We'd be relatively. Now, what would end up happening is that if we ended up running up on the S&P, we'd run down in here. The implied volatility would end up working, and then I would end up taking the entire trade off. Okay, for profit. This is nowhere close to what the profit would be if we had dropped down here after the election, because that convexity in the bump in the skew wouldn't end up being there, and we would end up making money at a quicker rate. If we had a big sell-off, and we were fearful that the country was going to be over because it would be destroyed because of the election, and the markets were plummeting, and the VXX was going up. What I would end up doing is I would have just taken off the upper wing, because the upper wing, the lower wing would have some money in it. If the lower wing had less than a dime in it, I would take it off also. But that's the way I would have ended up trading. Through this if. Comey didn't mess up my trade this morning. So that's basically, I also took a look at, what could I end up legging into this? I thought, well, hopefully if we get a little bit of a sell-off, what I would end up doing is that I would end up trying to leg into this by maybe going in it in 2 steps. Okay, and this was let me take it down here. I had to redo these because this was what I was looking at later. Do I do it in 2 steps? Do I do something like put the first step on, where I would end up basically buying the put vertical, first, and this should have been a 10. Do I buy my put vertical, first to end up letting things go? And let me show you what I would end up doing. I could leg into it, is basically, and it would depend on what you would end up thinking. Normally what I would have done, because I would have thought that we would have run up in volatility, but because of the FBI, I thought, well, we'll continue to end up running down if the market ends up moving up. And so do I buy this put vertical first, and then by the end of the day, sell the other side to be able to, they make me redraw this every single time. Do I end up legging into it so that I would have the position on that, we'll continue to get a volatility crush afterwards? And at this point, there's not enough edge in it. If anything, I would be looking, if volatility gets low enough by the end of the day, buying a VIX or a VXX vertical on the upside. Let's take a look at that, because on the upside, what I would probably end up doing is trying to look at some type of a VIX vertical. And let me come over to here. Let's just go out. We want it to end up being, relatively cheap. And if we end up going, we're going to end up running, rather significantly, I would think. So I don't need to buy anything that low. The problem, though, with the VIX is that after the event happens, it's kind of done, right? So I don't expect, even if the VIX would, how high could we end up going? And the answer is probably not very, very high, because the unknown has become known, meaning the election, and there's no impending events after this that we would have to end up worrying afterwards. It would be what would happen if the fear of Trump winning ended up winning. By the way, one of the things that we didn't end up mentioning that I did read is that some money managers were hedging for complete Democratic sweep. If you take a look at statistics and how the economy has grown with the different parties in charge of the House and the Senate and the presidency, what you find is historically, the markets have done best with a Democratic president and Republican-controlled House and Senate. If you take a look at the worst, the markets have ever performed, it's when the Democrats have had all 3, branches. And I know they're not the 3 branches of government, but all 3 branches of elected officials of presidency, House, and Senate. If you take a look at what's been done, and by the way, that's not a comment on the Democrats, because the second worst is when the Republicans have owned all of them. And so there was also some fear. I think that could end up happening, or at least some people were protecting it. So to me, this isn't the greatest way to end up doing this. If I go
Could you,
back,
Jim?
go
Could
ahead.
you hang on? Oh, don't change the screen yet. A lot of people understand this, but there may be some people that are unaware that the VIX, when you look at, you type in the VIX, you're trading options in the VIX, but the options are priced based on the um, DX, not the VIX. So when you're looking at it, they have the center at 18, but if you take a look at the deltas match what the VX is. So the VX is trading at a little under 17 right now. So when you look at this to place your options bets, you have to remember that you have to look at the VX chart, not the VIX chart.
Very, very critical. Okay, because what ends up happening is that, and somebody's going to go and read this, and what they're going to read is that they're going, oh, but what Jim and Paul said wasn't true. Yes, it does settle on the VIX, but so does the VIX futures. Okay, um, but it gets priced on the VIX futures, not on the actual VIX itself. Okay, very important. Right, very, very important. Okay. Couple of questions. I have a VIX 23 call option for November 16th. Okay. They were cheap. I'm wondering if I should hold them through election. 23s are worth the challenge that you have. Okay, for the 23s. Now I would definitely keep them. It's a November option. Yeah, it says November 16th. Good. So we're looking at the right ones. The thing about going shorter term, okay, and this is important, okay, if it was a 23 option in December or January, I wouldn't think it would be worth as much because remember, what ends up happening is that the way you're going to end up making money, okay, by the 16th, is that it's going to end up dropping and be fearful by the 16th. One of the things that what we had seen, but by the way, I we being the EAB guys, right? They're the guys that do the institutional hedging. We had seen some very, very large butterflies being traded below the current price of the VXX last week. And we saw them being placed on the monthlies. While we ended up agreeing and we thought that they were great trades, we ended up saying we thought that instead of going on November 16th, because it's the VXX, we'd rather go on November 11th. Because what would end up happening, and I think that Apple is probably a great example of an event, and let's go and take a look at this, of an event that ended up happening, and then what happens afterwards. After the event happens, you will end up continuing to get a drift. Okay, and so if I come over to here, yeah, I draw these same charts, lines pretty much on everything. What ended up happening is, look at what ended up happening on the day of earnings. Yeah, we had a drop. Okay, it wasn't anything terrible, but then look at what ended up happening. So if you ended up expiring, okay, the Friday afterwards, you were in pretty good shape. But what happens if you use the monthlies? Well, you dropped until at least yesterday, your drop after from close to close, meaning the close of the day before earnings was announced, the close after earnings were announced, it was only a few points, right? You dropped from 118 to 115 and change. And from 115, you went down to 108. And so the challenge that I have when people end up using longer term options, if you're playing for the event, hedge the event. Okay? If you're playing for the event that's happening tomorrow, why would you be using, February or January options? In this case, vol's going to be so dramatic in the way it's going to move that extra week would end up making a big difference, just the way it did in the Apple earnings. I just wanted to end up bringing that up because I thought it was It was something that I had watched and I ended up seeing. So if I took a look at this, the 23, the problem is um, the 23 is probably going to end up getting crushed. I would say statistically, okay, owning the 23 option, okay, you're going to end up losing money, most of the time. Paul, you have an idea what 90%, 95%?
Yeah, I'd say 95%.
Yeah, and I
But
think that Paul and I, yeah, I think we're being conservative. I think it's probably even going to be higher than that. But the problem
Rich,
is that the
I'd like to ask Rich a question because this is, and I'll explain how I trade the VIX. Trading volatility. How much capital do you have invested in those 23s?
there's a lottery ticket,
Okay,
$150,
$150. So why even bother fiddling
taking
with
it
it
off.
and close it? Right. Because
Don't bother taking it off.
yeah, that's how I trade the volatility products. My position that I have on right now is a half size. I put it on and leave it. If I lose it all, I lose it all. I'm okay with that. Because what I found when I back tested doing these kind of trades is that inevitably you get pushed out of the market because it goes against you. Then the market turns around and would have given you all the money that you thought. So it's a matter of allocating the trade size so that you could live with the total loss, which $150 is. Yeah,
Not a lot.
not a lot. So, I've got $500 invested in the VIX puts. If the market doesn't like the election, my plan is to double up on the way down because that'll be my total allocation, and then just wait. I do my puts out longer term because it takes a while for the VIX to actually fall back down to where it belongs.
Yeah,
It,
if I took a look at it, it's
I mean, to
if
go up, you have to. I agree, Jim. You have to be in the event if you're playing calls because the event lasts. The VIX spikes are very, very short term.
it's the thing is, for those of you that don't know, I spent Paul. This was from the time that I started with the EAB guys because you were in the office. Had to
Yes.
be probably about 2.5 years. We spent looking at using VIX-based products to hedge our S&P, and we tried to our S&P positions, and we tried to do it systematically. Because remember, if we're going to end up doing this from an institutional point of view, we need to be able to put on, thousands of contracts and be, our timing can never be, great because of what it takes to get into and out of a position if you're going to be trading, 50,000 SPX contract. I'm sorry, 50,000 VIX contracts, or let's say a few thousand SPX contracts. And the problem is that if you got the timing perfect, there's no better hedge in the world. We could not systematically get the hedge to end up working perfectly. And so what ends up happening here is that in November, I fully expect, the VIX to end up, coming down, even with the market running up since we've done this call. The VIX is fluttered. It really hasn't moved that much. Here, I'll take another one. And I'm sorry, I have so many charts open that this is just terrible. How slow Thinkorswim is on this. But what I'll do is I end up taking a look at the E-mini futures versus the VIX futures, and I put them in a chart like this. Okay, so look at what's happened here. Okay, and let's we've run up more. What's happened with the VIX? Not a lot. Oh, VIX futures, not a lot, right? It's trading at 17. And so could we look at maybe buying a 1929 call spread? Meaning, do I do something like this? Do I put in some type of call spread where I can at least collect, say, 20 cents or so, 25 cents, to be able to end up offsetting some of the cost. And now this can only make $9 plus what I spend for it, so I can only make $7.85 on it. It's a better trade, I think, statistically than just going out and buying. But I don't I don't like this. What I think that what might end up being a better hedge, and I have to end up going back and taking a look at this. But if I take a look, what might be a better hedge is buying some type of a vertical. If you think it's going to go way down here, or if you don't think so, if you think the market's going to go down, buying a put here and selling one here would be to me a better hedge. So if I take a look at this on November 11th, what can we end up getting for these? We can get $12. That's not a bad trade. Let me show you what I'm talking about. Okay, so you need to end up. Can I keep them both open? I'm going to have to flip back and forth. Okay, so let me come over here. Go back to the SPX. The bottom of the skew curve is around, say, 21. We can never do this because it's around 2,200. But let me show you what we're looking at here. How come? Come on, you can do this, Thinkorswim. Don't be so slow, please.
That's a new enhancement to the program.
Yeah. What I need to end up doing, and it's partially me because I keep opening up things, but I need to end up opening up a window without any trades in it. So let me do this. Hang on, let me. Give me 1 second, and I'll end up getting this. Just need to get a window without any crap in it. Oops, somebody got a trade. Let's make that smaller. Let's make that smaller. Let's come up over here and take this one, and let's get rid of all of the trades. And it's coming up in 1 second. Okay. Okay, so there we go. So what we ended up taking a look at is that we had a very high implied volatility, okay, skew over here on the 11th, right? I could take a look at the 14th also, but I'm looking at the 11th. Okay, so what I would want to end up doing is that I want to end up buying something if I thought that the market was going to be going down. Okay, I got a good statistical chance here. So buying something that would end up being relatively cheap above here in terms of a put, and then selling something here, I could do this, and I can do this pretty cheaply. So I mean, if I did it statistically, I'd probably want to end up buying, the 2091. I'm sorry, the 2190, and then selling something over here at, being able to get at least a few dollars for it. And get, maybe the 2100 or a little bit lower. So let's take a look and see what that looks like here. Let me get rid of everything except for the 11th. Okay, see the 11th right here. Okay. So doing something like, if you take a look here, the implied volatilities, you see right over here, here's the low point. You can see how implied volatilities go up. But if I come over here, I can still get a 21 volatility, maybe a 2150. Right? And if I ended up buying a vertical, and then the one that I would want to end up selling is something that has a much higher volatility. If I take a look over here, here are 33 volatilities. So for a 100-point wide spread, if I bought the 2150 and I sold, 2150, and I sold the 2100, and I'm trying to change it right now. I'm almost there, guys. It's just very slow. Okay, there it is. Okay, so here's the 100-point wide. Oh, no, that's not quite 100 points, 85. If I go to 50. There we go. All right, the 100-point wide vertical. is trading at $28. So it pays almost a little less than 3 to 1. Okay. If you take a look at where we are right now, okay, at 21.20. Okay. The volatilities are in our favor. Is it a great hedge? No, but it's one that has statistical advantage for you. And if I come over here and I end up reshaping it, okay. So with the market continuing to run up, right, with the marketing continuing to run up, if you believe that, the other thing, okay, I told you James Comey and the FBI kind of messed up my trade. Here's where maybe they have it. With the implied volatility being so incredibly steep, if anybody who wants to vote for an upset, meaning vote that they think that Trump would end up going, the market's going to pull back, right? And if the market ends up pulling back, we're going to get below 21.50. So by buying something at a very low vol and selling it at a very high vol, you have statistical advantage. Okay, so you can end up buying a vertical, okay, and it would end up paying off. It would end up paying off nicely. Okay, so I think that that's probably a trade. Given what's happened with the markets right now, meaning that we've been running up, the entire time. If I pull this one back up. With us running up, it's probably with strength like this going into the election, they feel that they probably have to end up getting even more back. And if you remember, they become a little bit overconfident. You saw what ended up happening before Brexit. If you think, okay, it's an upset happens, that's probably the best statistical chance. Again, I'm not making any predictions. I take a look at the polls. I take a look more so as we talked about. I take a look at the London bookies, and it looks like Hillary's going to end up winning. If you want to end up, making a bet, okay, to be able to capitalize on it, probably the best statistical bet you could end up making versus everything we've looked at is to take advantage of the skew here. Bets on the upside. Because the implied volatility is so crushed down here, there's not a really good statistical, options bet. For this, you'd probably be best on just going long the futures, okay, the E-mini futures, and nice thing about the futures is that as you end up watching your TVs tomorrow to see who's winning, you could end up getting out of the trade at any point that you wanted to. So that's what I would think. Probably if you want to bet that the market's going to go up after the election, probably E-mini futures, okay, straight E-mini futures are going to end up being your best bet. If you think that it's going to end up going down, the best risk reward that you could probably put on is a wide put vertical, taking advantage of the skew. Questions? Okay. Okay. Richard bought one E-mini future at 2 a.m. today, okay, to balance, okay, off the loss of the $1,500 that it was showing at the time. So if you ended up buying, okay, if I come back here, if you ended up buying your E-mini future at 2 a.m., you have a very tidy little profit. You've run up 13 points, 13 handles. Okay. So it's realizing that, these things are, just minor moves, okay, before the big events. I have one last point that I kind of want to make around this, Paul, and then I'll turn it over to you for your closing comments. There are two types of trades that you can end up making going into events. Those that you want to end up putting on that are designed to end up getting out of the trade before the event. Good trades for that would have been not to say buy your broken wing butterfly, okay, below the money like you would in a road trip or Kevlar or an M3 or whatever, but it would have been to actually hit to sell it. Why? Because the volatility would go up towards the center of the curve, and you can end up you can take advantage of that. Now that's a trade that you'd end up putting on, okay, that you would plan on taking off before okay, the event happens. The event or the trade that you'd want to end up putting on for after the event would to be end up playing for the volatility collapse, but with enough hedge that if the market ended up moving. Now these are really hard trades to put on. Usually, usually when I put those types of trades on, I try to put them on so that you're going to have to guess which direction the market's going to go. So if you can end up guessing in the direction that the market's going to end up going and you play the volatility collapse, um, you're still going to have to be right, but a lot of times you can end up getting your trade so that you can like risk one to make, three. And if you could risk one to make three, then you end up having, a great trade on. Now you never get 1 to 3, but maybe you get 1 to 1.5. Okay, and that's a good trade. But you do have to end up being right to end up playing. Playing the volatility collapse on both sides is very, very difficult because if you're going to play the volatility collapse on both sides, you tend to have to end up being negative gamma. And if the market does run significantly, yeah, you'll make your $500 in the Vega collapse, but you'll lose $2,500 in your delta because it'll end up running. So whatever you end up playing, okay, however you end up doing this, always look through, okay, Paul, you and I used to do this all the time, look to see how you can lose money, okay, because that is so much more important than anything else. That's where you'll find where you'll end up getting hurt. I forgot there's a great Benjamin Graham quote that's, and I know I'm going to butcher it because I don't have it in front of me, but he basically ended up saying that risk is much more important than performance. Okay, the great portfolio management starts with the precept of good risk management. Paul, yours to close.
Oh, yeah, thanks. Uh, you know, we go into event risks. There's a lot of people that play them, like earnings plays, and a couple of comments. I don't play them, but if I was, I'd be picking a direction and making a bet and trading it small enough to lose 100%, and rather than trying with butterflies or calendars or even strangles. The problem with doing any of those is you have to pick the exact point where the market's going to end up. Otherwise, it can run right through your trade. So why do, just pick the direction and buy a call or buy a put and just make it small enough that you can absorb the loss and just ride it out. Don't look to adjust it. You're either going to make money or you're not.
I couldn't agree with you more, Paul. The thing is that I can tell you when I've reviewed traders' logs of what they've done, usually if I take a look at their initial trade versus their adjustments, usually they'll do better without their adjustments.
Right. Statistically, that no-touch trades work better in your overall equity curve. The problem becomes the drawdowns.
Exactly. So, and if you think about why people end up adjusting, right? The reason why they end up adjusting is because it's running outside of their tent or outside of their profit zone. So that means that when it's running up, they're having to buy into strength. And when it's running down outside of their tent to the left of their P&L, they're having to sell into weakness.
Right.
That's usually not a good strategy. So, anyway, guys, we hope that we gave you stuff to think about. Please let us know, okay, any topics that you guys would want to end up seeing, and we look to see you guys next week when we end up doing a review of how all of this, turns out for the elections. Thank you very much, guys.
Have a great day. Trade safe.